In this video, I'll teach you how to trade crypto futures or perpetual futures as they're often known, including how to use margin and leverage, how to open and close positions, and everything else you need to know. Timestamps for everything will be down in the description. Firstly, I'll explain what crypto futures are and how they're different to spot trading. Spot is what most people trade right here. This is where you cash settle your trades. If you want to buy $1,000 of Bitcoin, you need $1,000 on the platform. You swap the money for the Bitcoin becomes your property immediately once you trade. That's your property. You can withdraw it from the platform or do anything else. With futures, we are not trading the assets at all. We're simply opening and closing positions based on the price of the assets. So this is a synthetic trade. We are essentially trading a contract between long and short, or buyer and seller. We're not trading the asset. We never own the asset. We don't have the asset on the platform to withdraw or anything like that. We simply open a position and close a position, and then we make a profit or a loss. That's it. So we are just trading the price of the assets. This is a synthetic market which aims to track the underlying pair that you're trading. So up in the top left, I'm trading Bitcoin USDT. What I'm actually trading is the futures contract, which aims to track the price of the actual underlying spot pair, which is a different market. So we open and close a position, we open and close a trade, and we make a profit or a loss. That's it. Now, with trading contracts and just trading the price, that means that we never own the asset, which also means that we can go long or short immediately. Opening a long is like buying, where you buy a price, you open your trade, and if the price goes up, you make your profit. If the price goes down, you make a loss. Opening a short is essentially like selling. The reason it's not called selling is because we don't own the asset to sell. So you can't sell something you don't own. However, you can take a short trade or a short position, which is similar to selling, where you actually take a short first. So you take a sell side trade first, and then you benefit when the price goes down and when you close your trade. So you're essentially buying low and selling high, but you're selling high first, aiming to buy back lower to close out the trade and make your profit. If the price goes up, you actually lose money on that trade. So that's the difference between spot and futures. We are just trading the price. We're trading a contract and we open and close our trade. And then between when we open and close it, we either make a profit or a loss. I'll show you trading crypto futures on Bybit, which is one of the platforms I use the most. This may not be your platform and it may not be available in your region. However, the techniques that I show you, like funding your account, opening positions, using leverage, all of that is going to be the same no matter which platform that you use. So down in the description, I'll leave the top exchanges and details on which currencies that they support and which regions that they are best in. If you can, just try and use one of the big 6 exchanges. But some of these now have professional investor questionnaires where you have to be a professional investor to trade futures. Now, some of these give absolutely amazing deposit and trading bonuses for new users as well, including Bybit. It's the one I use the most. So I'll leave all of those details down below. A lot of people are now using decentralized exchanges to trade. So for example, on Bybit, they actually have a DEX themselves called Apex, which is the one I use the most. This is a decentralized exchange where you connect your crypto wallet and trade very easily on here. The difference is because it's a decentralized exchange, they don't custody your assets. And that means that they don't have to do KYC or any of the other checks. So it's up to you whether you want to use that. Some people are using that versus using centralized exchanges now. All of the details for those exchanges and everything else, I'll just leave it in the description so you can find out as much or as little as you want. Now I'll explain exactly how to fund your trading account and how this works when opening trades. With spot trading, you have an amount of cash, you can swap that for an asset and that's it. With crypto futures, that's not how it works. With futures, what you have to do is fund your account with some value, and that value is used to fund potential losses in your trades. The only thing the crypto exchange worries about when trading futures is that you can fund a potential loss. And we have to put some collateral in there to fund any potential losses in our trades. So how can you fund your trading account? You can use stablecoins if you want, like USDT or USDC or a bunch of others that are now accepted. Or you can put coins on there as well, like Bitcoin or ETH. They have a value and they can get sold off to fund potential losses as well. So that's really how we fund our accounts. It doesn't actually matter what you're using to fund. It just matters that you have some value there that can get liquidated. Now, Bybit have a system called a unified trading account. This is what most of the larger exchanges have. This means that you put some assets in your unified trading account and you can use the dollar value of those to fund your positions. So if I show the unified trading account here, I'll reference this throughout the video, but you can see I've put some USDC in my unified trading account, and I can use this as value to open trades. All Bybit cares about, or all any exchange cares about, is that if I make a loss in my trade, I've got enough cash there that they can use to get out of the position and liquidate my cash and basically pay the loss in the trade and get out of the trade, because they're never going to allow a bad debt. So that's the first thing. You want to fund your account. The second thing is, because the exchange only cares about us paying for potential losses, that means that they can let us trade with leverage, which is a larger trade in relation to the cash that we have. So let's say I put $1,000 on the account. They will let us trade with 2, 5, 10x leverage. That means that the trade size that I can open is $2,000, $5,000, $10,000 worth. Why would they let us do that? Why would they let us trade with more than we have? Because the only thing they care about is that we have enough cash or value to pay for potential losses in that trade. So I can open up a $10,000 position, no problem, because I have $1,000 in cash to pay for a potential loss in that trade. And if the loss gets too large, then the exchange will just say, you don't have any more cash to fund this trade, we're going to liquidate your cash and pay off the loss and get you out of the trade. That's all they care about. That's why we can trade with more cash or more size in the market than the cash that we actually have. So looking at leverage, you don't have to use leverage when trading futures. You can just cash fund your trades. You can use a small amount of leverage, you can use a large amount of leverage, but the larger the leverage goes in relation to your cash, the more volatile it is in relation to the amount of cash you have there. So with 2x leverage on $1,000 collateral, you can open up a $2,000 trade size. 5x is 5,000, 10x is 10,000, right? However, with 2x leverage, a 10% loss in your trade is now $200, which is 10% of your trade size. But of course, a $200 loss is actually 20% of your original capital. So getting up to a 10x leverage trade, a 10% loss in a 10x leverage trade is $1,000, which is 100% of our capital. So you can see that using leverage makes wins and losses or percentage movements much larger in relation to your underlying capital. And that is, of course, something we have to keep an eye on, because we have to fund potential losses. So if I'm using a 10x leverage trade, that means that the price can fall 10% and then I get liquidated, right? So I have to be very cautious about the trades that I'm getting into. If I'm using 2x leverage, well, that means that the trade size is 2x the cash that I have down, or another way of saying that is that I'm funding around 50% of that trade. If I have $1,000 cash and it's a $2,000 trade, I'm funding 50%, which means I can now withstand a 50% move to the downside if I'm long before I get liquidated. When trading futures, it's really the only thing to think about is how much volatility to the downside can I withstand, and how much cash do I have in the position to withstand downside volatility, right? So volatility against my trade. And of course, you can add collateral later if you want into your account and fund the position more and everything like that. But that is the only thing to worry about, is how much cash do you have in the trade and how much downside volatility can you handle. So we use collateral assets to fund. We open up trades of a certain size, either low or high leverage. And then obviously we have to worry about potential liquidations with downside volatility. Like I said, there's two ways to fund your trades, and this allows for certain different types of trades. So the first way, and the way that most people use crypto futures, is to fund it with US dollar stablecoins. So USDC, USDT. This is popular because it's easy to work out how much cash you have in your account, and that means you can fund your positions very easily. So let's say I have $1,000 in the account of USDT. That is cash there, and that's not going to change in value. When you're trading crypto futures, everything is cash settled, so you know you have $1,000 to fund potential losses. It's easy, and you can increase or decrease the volatility via leverage. So if you're using 2x leverage, you can withstand a 50% downside move, so you can withstand a lot of volatility. If you're using 10x leverage, that's 10 times your trade size versus your cash, you can only withstand a 10% downside move. So that makes it more volatile. It also increases the amount that you make or lose in relation to your cash. Right? $10,000 trade is going to make or lose much more dollars than 2x leverage trade on your cash. That's the easy way to do things. It's how most people trade. Now, the other way to trade is with coin margined futures. There's two very important differences here. The first one with coin margined is that profits and losses are exchanged in the coin of the currency pair that you're trading and not dollars. So if I have a long Bitcoin trade and the price goes up, I make that trade, I make that win, and the profit is in Bitcoin. So the Bitcoin comes back into your account and not dollars, unlike this one. The second thing is that we're using volatile assets as the collateral to fund our trades. So let's say I have $1,000 of Bitcoin in the account that I put in to fund a trade. I go long and Bitcoin falls 10%. Well, my trade is now down 10%, but my collateral also is down 10%. So I now only have $900 of collateral to fund that position, which is also losing. It's much more volatile using these volatile assets to fund your trades because the assets themselves move in price. Of course, if the price goes up, then the percentage that you make is much, much higher as well because the price is going up, so your trade is winning and your collateral is going up as well. Wins and losses and percentage moves in the price are highly volatile when using coin margined, much more volatile than stable coin margined. And you can get liquidated extremely quickly because you lose your trade and the collateral goes down. And when you make wins, those percentage wins are much higher than using stablecoin margined as well. And you exchange the profit or the loss in the coin itself. Using coin margin futures also gives us access to a trade type that we can't get in stablecoin margined, which is known as a hedged trade. A hedged trade is where you take a trade in the market that is going to actually hedge out some exposure that you have in the underlying. What I mean by that is, let's say we have Bitcoin and we think the price is going to fall in a bear market. So what are we going to do? If we keep the Bitcoin and the price goes down, we just lose value in that trade. The other way to do it is to use Bitcoin as collateral to fund a short trade in Bitcoin. If we have a short trade in Bitcoin and the price falls, our trade will win and make money because we're short. So we essentially sold up here and we can buy back lower. Now that makes money for us in the trade. However, the collateral is still falling in value, right? So the collateral is falling in value, but the trade is making money. And that's why it's known as a hedge, because the trade is hedging out some of the losses that you're making in the underlying collateral. So instead of just outright selling the asset, we can take a short position and try and hedge some of the downside. The reason is if you sold the Bitcoin, you would have a capital gains liability. You don't really want to sell your assets, right? Trading around the edges of your portfolio. So you can take a short trade and try and hedge some potential downside that you think is happening. The other side of that, of course, is that if the price doesn't go down and the price goes up, then of course we're giving up upside because the underlying Bitcoin collateral is going to rise in value, but our trade, our short trade, is going to lose, right? So we're going to make losses in that trade, which is going to take away the upside in the underlying collateral. So with a hedged trade, you're essentially giving up potential upside in order to hedge some potential downside exposure. When trading futures contracts as well, especially on the larger exchanges, you'll have a choice of two different types of contract. Come up to your trading system. So on Bybit, it's futures here. Now for Bybit and all of the other major exchanges, I have tutorial videos going through how to trade specifically on those platforms. So just go down in the description if you want to know on the platform that you use. As I said, I'll leave the deposit and trading bonuses on all of those exchanges down below as well. If you're a new user on any exchange, you can get usually a good deposit bonus, especially when trading futures. So if you go into trading the futures contract, so trade futures here, choose the currency pair that you want to trade, and you can choose any of them here. However, up at the top, you can see perpetual and futures. Futures have an expiry date. So you're trading a specific date in the future. So you have to take a position and think from when you open that position to when you close that position and that date, what is going to happen? Do you want to go long or short? And there is an expiry, and at that expiry date, the futures contract closes, and any profit or loss that you have, that's going to be put back into your account. Most people in crypto trade perpetual futures. Right here, as you can see, perpetual meaning no expiry date. So you can open a position and you close it when you want. It's not going to expire. Most people trade these because it gives them much more flexibility. The other major difference between futures and perpetuals is the funding rate. Futures contracts with expiry dates do not have a funding rate, so you don't have to worry about it. Perpetual futures do have a funding rate. We either have to pay this or we receive it depending on the circumstances. This contract right here is not really Bitcoin USDT. It's just a contract. It's a different market with different buyers and sellers and different influences on the price in comparison to the underlying. But if this price doesn't track the underlying Bitcoin USDT spot trading pair 100%, it's going to be an unreliable contract and no one can trade it. So this has to be kept in line perfectly with what the actual Bitcoin USDT spot pair is trading, the price. So how do we do that? Because it's a completely different market. That's what the funding rate is for. It's a fee to make sure that buyers and sellers keep in line. If there's too many buyers pushing the futures price up, that's not good. So the exchange is going to come in and say, buyers are pushing the price up, positive funding, buyers have to pay this fee to the other side of the order book, the sellers, in order to disincentivize buying and incentivize sellers to come in and hedge out their positions and earn the funding fee. So positive funding is when longs pay a fee to the other side. Negative funding, of course, is when there's too many sellers pushing the price down in relation to spot. And that means the sellers, or the short side of the order book, they have to pay that funding fee to buyers or longs coming in to push the price back up. So sometimes funding is positive, meaning the price of the futures contract is too high, so buyers have to pay. Sometimes funding is negative, meaning sellers have to pay the buyers. We don't really know what's going to happen over time. Sometimes it's positive, sometimes it's negative. In any case, what you can do is figure out the funding rate. So the funding rate is 0.01%. exchanged every maybe 3, 4, 8 hours, depending on the exchange. In big pairs, the funding rate is usually around 10% yearly. So you have to figure it out. If you have a position open for a year, you may have to pay 10% funding. Or if it's positive, negative, half the time, that may cancel itself out and it may not be a lot. But it's something you have to be aware of. Make sure that you have cash to fund your positions if they're open, because you may have to fund this out. You may have to pay this out. During times of very high volatility, you may see funding get very high as well. So in bull markets, funding is usually positive as buyers are coming in, having to pay that. In bear markets, funding can be flat or maybe negative. We don't know what's going to happen, right? But just make sure that you're cognizant of it and have some cash in your account to fund any potential funding rates. We know that we have to put some value in our account to margin our positions. How do we do that? You're going to have to choose either cross or isolated margin. In every crypto exchange. You can see here the drop down, it says isolated or cross. Now on Bybit as well, we can choose this margin mode here. So I'm going to press cross margin and we can choose between them. So isolated margin isolates your positions individually, and usually you can only use the crypto asset of the pair that you're trading. So let's say I'm trading Bitcoin USDT. With isolated margin, I can use USDT to margin that position. I can't use ETH or the dollar value of ETH, that's not going to work. So I'm trading Bitcoin USDT, isolated. It's isolated to the currency pair that I'm trading. That's the margin that I can use. And each individual position is going to have an isolated amount of margin. So if I have a Bitcoin position and an ETH position, I can use USDT to fund those, but those positions are isolated. If one of the positions loses, the other is fine. That does its own thing. That's isolated. Now with cross margin, this uses any assets in your account to fund all trades. So I can have a Bitcoin position, an ETH position, a Solana position, and all of those are being funded by the same assets all at once. And also with cross margin, you can use the dollar value of multi-asset collateral. So this is where in our unified trading account, I can trade Bitcoin USDT, but I have Bitcoin, ETH, Sol, and 3 different stable coins, and the dollar value of that is margining the position. This is obviously more volatile because now you have potentially volatile assets margining your positions, but it also gives you much more flexibility in the way that you trade, in the way that you margin your positions. This uses all of that value to margin all positions. That means that if one position really goes south, it can drag other positions as well, and it can liquidate you from that one position. With isolated margin, If you make a long trade in Bitcoin, a long trade in ETH, Bitcoin loses, your ETH position is going to be fine because it's isolated that margin. So this may be a little bit more simple to get your head around if you're a new user. This is more flexible, slightly more volatile, but gives you more options. On Bybit, once you've chosen one of these, you can't change it if you have an open position. So if you want to choose one and you want positions to run a long time, just make sure that you're in the right mode. Otherwise, you'd have to close all of your positions, then change the margin mode, then open again. In other exchanges, you may not see this. It may just be one account that you use, and then you choose between cross and isolated. But that's what you have to choose, either cross or isolated. That is how you're margining your positions. You can also choose the automatic amount of leverage that is used when you open your trades. Leverage being trade size in relation to cash down. So 2x leverage means that the trade size is twice my cash. The other way of saying that is that you have to fund half of your trade. So if we say that we're going to open a value, you can change this, by the way. So I've got USDT just to make it easy for this example, but you can do order by quantity if you want to trade a specific amount of the asset that you're trading. Order by value just makes it easy. So let's say that I have a $100 trade. Well, with 2x leverage, that means that the trade size, the value that I trade with the market, is 2x my cash. So I fund 50% of it, which is $50. That's the cost to me to open the trade. I tie up that amount of cash or margin in the trade to fund the trade. Now, let's change the amount of leverage that we're using to 5x. Notice that the trade value goes nowhere because that's the value that we're telling the system to trade with the market. However, because I'm using 5x leverage, that means the cost to me is now only $20. 20 times 5 is the value. So the value doesn't change with leverage. The only thing that changes is the amount of cash you have down to fund that position. Obviously, with 10x leverage, we're looking at funding 10% of the position. So now only $10 cost, $100 value. The only thing that changes is our liquidation price in this example. With 2x leverage, like I said, you can fund a 50% downside move. With 10x leverage, you can fund a 10% downside move because you have that cash tied up to go ahead and trade with, right? You have this $10 tied up to fund that $100 position. You can only fund a 10% move. So you can choose this as you want. Let's do 1x, right? You can choose exactly the leverage that you want. I'm actually going to do customize here as well. And we're going to use 2x leverage. So we can do that too. Press confirm. So now we have 2x leverage funding 50% of the trade. The automatic amount of leverage that you use is good to know, but it's actually a little bit irrelevant in the big scheme of things because once you have a trade open, you can adjust the amount of leverage. So you can put more cash into the trade to fund more potential downside, or if the trade is winning, you can take leverage out as the position earns equity and earns profits. Also, what you should really worry about is the effective leverage in your account. So let's say that I open a $100 trade with 2x leverage and the cost is 50 to me, that's fine. But if I have $1,000 in my account, then I can fund this trade the whole way. And the amount of margin, the amount of money that I have in my trading account, that is going to be used to fund this position. So the effective leverage versus the amount of actual cash that I have in my trading account is tiny, and it's not 2x, right? Because I have way more cash. So the effective leverage that you have is the most important thing. Once you start trading, you will notice that you have a margin balance and an available balance, and this is going to change depending on profits and losses. So if you make profits in your account, you're going to have more equity in your account to trade with. If you have $10,000 in your account and you have a $100 trade, which is 10x leverage, it's not 10x leverage. Your effective leverage is much more because you have assets there that will be used to fund your trades. Now I'll show you how to open a position, think about volatility and leverage and stop losses. So many people use a stop loss when they trade futures because this is more for day trading and active trading. A stop loss is where you get out of the trade at a specific loss price. You can have that or not as you wish. So with a stop loss, let's do an example. Let's say that I'm going to open a long trade. This is the price right here. And my technical analysis says that I'm willing for the price to go down here and accept that amount of downside, and I'll keep the trade open. But if we go below this, then we've basically broken down through all of these levels, and I want to get out of the trade because I don't want to sit on like a 40% loss if we go lower. So this level is important to me now. It's a 20% loss, as you can see. With a 20% loss, that means that I can actually use 5x leverage without increasing the actual volatility or risk in my position, because I'm going to get myself out at 20% loss. That means that I can use 5x leverage and fund 20% of the position. Let's call it 4x leverage to be safe, or 3x leverage. But if I'm using 3x leverage, that means that my position would get wiped out on a 33% move to the downside, which is here. That's fine for me because I'm going to stop myself out here. So even though I'm using higher leverage than say 1 or 2x, I'm not increasing the risk in my position here because I'm going to stop myself out before the position would get liquidated by the exchange. So higher leverage doesn't necessarily mean more risk in your position if you're using stop losses. The reason why you would use higher leverage here is because you don't need to fund more than that if you're going to stop yourself out at this price. Why would I fund myself a 50% loss with 2x leverage rather than this? This extra money can now be kept off of the exchange or put in a yield fund or something else, and that cash can be earning yield rather than sitting in a trade doing nothing. So that is where you can use leverage to just use your capital more efficiently rather than tying up in trades that's unnecessary. So that's up to you and how much leverage or how much volatility you think is going to happen and how much volatility that you want to fund in your account. So that's using leverage, not necessarily to increase the trade size, but just to fund the specific amount that you want to fund in your trade. Now, if you are not using stop losses, or you think, I want to withstand a much higher amount of volatility, then you're going to have to fund the trade a lot more, which means that, of course, you have to use less leverage, or you have to make sure that your account is able to, fund the volatility during the time that you have your trade open. When opening your order, you can put your take profit and stop loss prices in at the same time, or you can put them in after the fact or not put them in at all. Stop loss is, like I said, a specific loss price. A take profit is a specific price that you would get out of your position at a profit, and they will automatically trade for you if you want them in. I'll put them in after the fact though. So we're going to go cross margin, 5x leverage. I'm going to open this market order right here. You can see the cost to me, 1/5 of the order size. Open long, see all the details, press confirm, and that will trade for you. Now down here, you should see that we have an open position. So I just traded with the market order, so we got open immediately. But we have a Bitcoin USDT cross margin trade with 5x leverage. This is the quantity and order value, as you can see here, our entry price. This is the liquidation price. So you can put that on the screen if you want. That is, of course, when the amount of cash that I have tied up in the position is going to get wiped out. That's where I'd get liquidated. This price right here. I can put a stop loss price in above this if I want. You can see the P&L and running P&L. Realized P&L, you can close a certain percentage of this trade. If you make a profit, then you're taking that out of the trade, and that is a realized profit or loss. With running, that's the trade that is actually live in the market. Is it making a profit or a loss? So that's right there. And the main thing really is the liquidation price to make sure that we can fund the trade to any volatility amount that we want. If you didn't put your take profit and stop loss orders in at the time that you traded, you can add them in right here after the fact, at least on most major exchanges. So add, choose either the take profit level by ROI, percentage change, or by the P&L. It's up to you. So let's put in the size and the amount that we want to trade here. You can see that. And then stop loss, you put that in at some price underneath, and you see what the loss is going to be. You can put that in whatever you want. Those orders will go onto the system, and they will only trade if those prices are hit. So this stop loss is now 102. If 102 gets hit, then the order will get triggered and come in. And obviously, because we're long, it will sell us out and concrete that loss. Up here, this would be the price. And once that price is triggered, that would sell for us and obviously get out of the position at win. So you can put those in if you want, press confirm, and those would be tied to this order. So they will only exist as long as this order is still live, and they will change if you close a certain part of this order as well. If you cancel this order out, those TP and SL orders will also be completely cancelled as not to trade without your live order there. Of course, if you want to close the trade as well, then you can come up here, press close, and we can trade a percentage of it. So you don't have to close the whole entire thing. Let's say that you want to trade a certain percentage, press close, close the percentage. Now, notice that I don't have a short position in the market. I only have a long position, right? So it's not going to let me close a short because I don't have one. What we want to do is close the long. So you can say, I want to close 50% of the order, press close long. that will reduce your order by that amount. Or you can, of course, close all. So down here, close all by market order. You can see close by market like this. It's just going to say how much of the order do you want to close, right? So 100%, I'm just going to press confirm, and then the order is closed out, and the profit or loss that you make, that will be exchanged into your unified trading account. Opening a short position is the mirror image of what we've just done, but it's exactly the same thing. So cross margin, 5x leverage, open, market order, same size, open short, confirm. So what we've done here is essentially sold the asset. We haven't sold, right, because we've opened a position. We haven't got the asset to sell, but we've essentially taken a short position on the price, selling it. So we want to buy back lower to close out the trade and make a profit. So short trades benefit as the price falls because we sold and we buy back lower. So you can see here we've got a Bitcoin USDT perp trade, cross margin, 5x leverage. This is red now, which is obviously a short trade. Exactly the same. You can put your take profit and stop loss in here. A take profit is going to be below the price now, and a stop loss is going to be above the price. So you can put that in. Now we have USDT to fund price changes, right? So you're going to have to now work out what price can the price get to where I want to take a loss. Of course, with shorts, it's known as a more risky trade because the price can rise to infinity. But obviously, it's just going to rise and then take out the cash that you have in your position. So at some point, you're going to get liquidated having to fund if the price moves against you. Similar to taking a long as well, which is you're going to get liquidated at some point unless you fund the whole position again by putting more cash in. But with shorts, of course, the price can technically rise to infinity. So if you fund the position a bit and a bit more, you could technically be funding that at some point. You know, you could be in really big trouble and then have to close the position at a massive loss. You know, at least with a long, your max potential loss is 100% downside move plus the leverage that you've taken. But you put your TPSL in all the same, you make your realized P&L all the same, and you can close it all the same. Now, because I've got a short trade in now, we want to go to close, and you can see I've only got this short trade in, so I can only close the short position by essentially going long and you know, making the position 0, so no position here. So close short, or down here, just above my head, I can choose market order, close, confirm, and that gets the order out for me. If you want to trade coin margin futures on Bybit and most other exchanges, they will actually be a separate account. And that's because you do have to margin your position with the coin collateral because your profits and losses are exchanged in that as well. So you have to be able to fund a loss with the coin that you have to exchange. And so we can go up to trade here, futures, and on Bybit, they're actually known as inverse contracts. That is coin margined, and you exchange profits or losses in the coin itself. That's different to these, which are just normal cash margin, US dollar margined, or US dollar stablecoin margined. Inverse right here, you can choose the assets to trade. Notice that the margin balance, you do have to put the coin on that you're trading. This is the Bitcoin pair, so Bitcoin is the asset that we exchange value in. But it's all the same. If you want to go long, you can do that, and you make much more volatile gains to the upside because the trade position wins and your collateral is moving up and you're getting paid back in the asset itself. Much higher volatility upside moves and downside moves as well. If you want to take a short trade here, you can do, and that's a hedged trade because we have Bitcoin collateral. Let's say Bitcoin moves down, your short is going to win. So you're hedging out some of your downside exposure. If the price of Bitcoin moves up, your short trade is going to lose, taking away any potential gains in the underlying. And if you're using leverage, you can actually lose more than the gains in the underlying asset. So just be careful with coin margin. It is very volatile, and hedging as well. If you're using a lot of leverage, you can still make some losses there because your loss can be much higher than the asset itself is moving. But inverse or coin margin is different on Bybit and most other exchanges versus cash margin futures here, which are a completely different market. In the description box below, I'll leave the deposit and trading bonuses on the exchanges I use if you want to trade on them, and some extra helpful videos on trading and tutorial videos for all of these exchanges specifically as well will all be listed in the description. I'm James, this is MoneyZG. Cheers for watching, and I'll see you in the next one.